Gold just had its worst 2-week collapse since 1983. Bombs are falling in the Middle East. Oil is above $100 a barrel. And gold, the one asset that is supposed to protect you from exactly this, is down nearly 20% from its all-time high. Sit with that for a second, because if you don't understand why that is happening, you are going to make the wrong decision next. And in a market moving this fast, the wrong decision costs more than the crash itself. Here is what I've learned after 40 years of watching markets behave in ways that seem to break their own rules. Gold is not broken. The rule most investors think governs gold, that one is broken. And understanding the difference between those two things is the most important financial insight you can have right now. Let me start with what actually happened. Gold hit an all-time high of $5,580 per ounce on January 28, 2026. By March 19th, it had dropped to $4,551. That is an 18.5% decline in less than 2 months. 7 consecutive sessions of selling, the longest losing streak since 2023. And during those 7 sessions, Iran's Revolutionary Guard closed the Strait of Hormuz. Oil hit $100 a barrel. Bombs fell on Tehran. The Middle East entered its most serious military escalation since 1973, and gold fell every single day. So either everything you believed about gold as a safe haven is wrong, or there is a mechanism operating underneath this market that most investors have never been taught to see. I've been watching that mechanism for 40 years. Here is exactly how it works. The number you need to understand is not the gold price. The number you need is 4.05. That is the current yield on the U.S. 10-year Treasury bond as of March 19, 2026. And that single number explains more about why gold is falling during a war than any analysis of the war itself. Here is the mechanism step by step. The Federal Reserve held rates steady on March 18th, but revised its 2026 inflation forecast higher, up to 2.7%. Chair Powell explicitly flagged energy price spillover from the Iran conflict, oil above $100, as justification for keeping policy restrictive. When the Fed says higher for longer, bond yields rise, the dollar strengthens, and gold, which produces no income, no interest, no dividend, suddenly faces a brutal comparison in the minds of every portfolio manager on the planet. Hold gold that pays nothing, or hold U.S. Treasuries that pay 4.25% with zero default risk. When yields are low, 1%, 2%, gold wins easily. The inflation protection more than compensates, but at 4.25%, with the dollar strengthening at the same time, the math of holding gold becomes genuinely painful. You are paying a 4.25% annual opportunity cost to own an asset that just fell 18%. Now here's the part that almost nobody explains clearly. The war didn't save gold. The war is the reason gold is falling. The war drove oil above $100. Oil above 100 drove inflation fears. Inflation fears drove the Fed hawkish. The Fed hawkish drove yields to 4.25%. Yields at 4.25% drove gold down. The war made gold's situation worse, not better. But there is a second mechanism operating at the same time. I call it the leverage unwind. And this is the one that turns a correction into a crash in hours. Throughout 2025 and early 2026, retail investors poured over $70 billion into gold ETFs. A significant chunk of that went into leveraged products, 2 times and 3 times ETFs that multiply the daily move. These products have a design feature most investors only discover when it costs them money. They rebalance every single day. When gold falls, the leveraged ETF is forced to sell to maintain its ratio. Lower prices trigger more selling. More selling creates lower prices. The cycle feeds itself until the entire leveraged position is liquidated. And that can happen in a single session. Look at what happened on the day the Hormuz news broke. Gold initially spiked from $5,296 to $5,423. Then it reversed hard, down more than 6% from the intraday high. Paper traders flushing positions, nothing more fundamental than that. The very products that helped retail investors ride gold up to $5,589 became the exact mechanism that crashed it back to $4,151 in 2 weeks. The retail investor was not selling because they changed their mind about gold. They were selling because the product they owned gave them no other option. Now I want to show you 3 layers underneath this crash that most financial media is completely missing. The first layer is the sovereign selling that nobody is talking about. In 1983, gold suffered one of its worst weekly declines in decades. The reason was not a financial crisis or a bank blow-up. It was Middle Eastern oil-producing nations selling gold to raise cash because their oil revenue had collapsed. Saudi Arabia, Qatar, Kuwait, They needed dollars to defend their currency pegs and fund their governments. They sold gold. That selling flooded the market and triggered a crash. The mechanism in 2026 is the same, inverted. Oil is at $100, but Gulf states cannot physically ship it because the Strait of Hormuz is closed. Storage is full. Saudi Arabia and Kuwait have already begun cutting production because they have nowhere to put the oil they are pumping. Revenue has collapsed, not because the price is low, but because the pathway is blocked. The same governments that built gold reserves for exactly this kind of rainy day are now experiencing exactly this kind of rainy day. Saudi Arabia holds 323 tons of gold. Qatar holds 115 tons. Kuwait holds 79 tons. They don't need to sell all of it to move the market. The exact 1983 playbook run by the exact same players for the exact same reason. The second layer is the algorithm amplification. Hedge fund algorithms do not read headlines. They do not know there is a war. They watch two numbers, the dollar index and the 10-year Treasury yield. When the dollar index rises above 99, the algorithm sells gold. When the 10-year yield rises above 4%, the algorithm sells gold. The yield hit 4.25%. The dollar index climbed toward 99.9. And billions of dollars in paper gold contracts were sold automatically. Not because any human decided the gold thesis was broken, but because the preset conditions for selling were triggered simultaneously across hundreds of algorithmic trading systems all running the same logic. The third layer is the one I find most important. It is the divergence between the paper market and the physical market. The paper price crashed, but physical gold premiums stayed elevated. Demand from stackers, jewelers, and institutional buyers held steady. The Shanghai Gold Exchange continued trading at a premium to COMEX paper prices. Asian central banks continued their purchasing programs without interruption. Physical gold is leaving COMEX vaults at an elevated rate, the same drainage pattern that was visible before the January all-time high. In 40 years, every time I have seen this divergence, paper selling hard while physical demand holds, it has not marked the end of a bull market. It has marked a transfer of ownership, from leveraged retail positions to unleveraged institutional and sovereign buyers who are comfortable waiting. So what do I actually watch? Not the war, not the daily price. Two numbers. Number one is the DXY, the US dollar index. When the DXY is above 100, gold faces a strong mechanical headwind. When it falls back below 97, which happens when the market starts pricing in Fed rate cuts again, that headwind reverses. The DXY tells you more about the short-term direction of gold than any geopolitical event on the planet. Number two is the 10-year Treasury yield. At 4.25%, the opportunity cost of holding gold is elevated and triggering mechanical selling across the board. When that yield drops below 3.5%, when recession fears override inflation fears, or when the Fed is forced to cut, the opportunity cost collapses and the selling reverses. Watch the yield, not the price of gold. The yield tells you when the short-term mechanism is turning. And here is what I know about the sustainability of that 4.25% yield. The United States is rolling over $9.2 trillion in debt this fiscal year alone. At 4.25%, that debt costs $391 billion more annually than it cost at 2% rates. The government is already paying over $1 trillion a year just in interest, more than the entire defense budget. That is the first time in American history that has ever happened. The arithmetic of sustaining 4.25% rates against a $36.2 trillion debt load is not indefinitely maintainable. The moment that arithmetic forces a policy response, a rate cut, a form of yield curve control, a return to quantitative easing under whatever name the next Fed chair chooses, the mechanical headwind against gold reverses. And when it reverses against the backdrop of central banks buying 863 tons of gold per year, that reversal will be fast, and it will recover this correction and more. JP Morgan's year-end 2026 price target for gold is $6,300 per ounce, unchanged. Deutsche Bank's target is $6,000, also unchanged. Both institutions had access to the same FOMC decision, the same dot plot revision, the same oil shock data that every retail investor was reacting to in real time. They looked at all of it and did not move their targets, not by a single dollar. That is the signal I watch. There are two types of investors watching this crash right now. The first type watched gold fall 18% during a war and concluded the gold thesis is broken. They sold, they locked in losses, and they will watch the recovery, which JP Morgan and Deutsche Bank are both still projecting at 30% above current prices, from the sidelines. Not because they were wrong about gold, because they mistook the short-term mechanical price for the structural price. The second type understands that two markets exist simultaneously. The paper market crashed because yields rose, the dollar strengthened, leveraged ETFs were force sold, and Gulf sovereign funds liquidated gold to cover blocked oil revenues. The exact 1983 playbook the physical market held because the property that makes gold valuable did not change when the Fed revised its dot plot. No counterparty risk, no issuer, no promise that can be broken.
In 1983, gold fell sharply. The investors who understood the crash was a sovereign cash flow event, not a structural change in gold's monetary role, accumulated patiently and held through the noise. The investors who mistook that crash for something structural sold at the bottom and missed everything that followed. The structural case for gold has not collapsed. The debt cycle didn't change on March 18th. The de-dollarization trend didn't change. The fiscal arithmetic of a government carrying $36.2 trillion in debt and paying over $1 trillion a year in interest, none of that changed when the dot plot was revised. The dot plot changed, the short-term price changed. The structure did not dot in a world where almost every financial activity incorporates credit risk, that of a state. A central bank and intermediary, gold remains the only asset without a counterparty. It makes no promises, pays no interest, and is not dependent on political decisions. That is as true at $4,551 as it was at $5,589. The price changed, the property did not. Watch the DXY, watch the 10-year yield. When the DXY breaks below 97 and the 10-year yield breaks below 3.5%, the mechanism reverses, against the backdrop of central banks buying 863 tons per year, a debt load that cannot sustain 4.25% rates indefinitely, and institutional price targets that were never withdrawn. The paper market crashed, the structural case did not. In 40 years, I have never seen those two things remain separated indefinitely. Most investors don't know the difference between the paper price and the structural price. Now you do. If you found this valuable, hit subscribe and turn on notifications so you never miss the next time markets seem to break their own rules. Drop a comment below. Are you buying this dip or are you waiting for the yield to break first? I'll see you in the next one.